Premiums go up. Coverage goes down. Executive pay goes up 27%. Any questions? If you pay for homeowners insurance, auto insurance, commercial insurance, or really any insurance policy in America right now, what I am about to say is something you need to hear before your next renewal notice shows up and ruins your morning coffee. Because insurance companies keep telling policyholders the same story. Premiums are going up because claims are expensive. Storms are expensive. Reinsurance is expensive. Fraud is expensive. Litigation is expensive. Construction is expensive. Labor is expensive. Attorneys are expensive. Public adjusters are expensive. Apparently, oxygen is probably expensive too. We just haven't received that endorsement yet. But here is the part they are not exactly highlighting in the renewal packet. According to the Consumer Federation of America, top executives at the 10 largest insurance companies received more than $134 million in total compensation in 2024. That was reportedly about a 27% increase from the year before. So while policyholders are getting higher premiums, weaker coverage, bigger deductibles, and more non-renewal notices, the executive suite appears to be doing just fine. And that raises a very simple question. Actually, a better question. Not just, why are premiums going up? The better question is this: what exactly are policyholders being forced to pay for? Claims, risk, reinsurance, or executive compensation, administrative bloat, shareholder comfort, and a claim defense machine dressed up as market necessity? Welcome back to the NAPAICC Insider, where we talk about insurance the way it actually works, not the way it sounds in a commercial with soft piano music and a smiling actor standing next to a fake kitchen island. I am Scott Harris, CEO of NAPAICC Inc., Florida Public Adjuster License Number W524910. We represent policyholders, not insurance companies. And today we are talking about the real insurance crisis in America. Premiums are rising, coverage is shrinking, executive compensation is climbing, and the numbers are not subtle. Before we go any further, let's be clear. This is not an argument that executives should not be paid. Running a major insurance company is complex. Risk is real. Storms are real. Reinsurance pressure is real. Construction inflation is real. Fraud exists. Litigation exists. Nobody serious is pretending those things do not matter. But here is where the story starts to break down. The industry keeps asking policyholders to accept pain as necessary. Pay more, accept less. Absorb bigger deductibles, accept more exclusions, lose coverage, get non-renewed. Be grateful anyone will insure you at all. Meanwhile, executive compensation goes up. So forgive the public if they ask a few uncomfortable questions. That is not anti-business. That is common sense. Remember common sense? It used to be popular before everyone decided a 40-page renewal packet was consumer communication. Let's start with the story policyholders keep hearing. Every time premiums rise, the explanation is usually some version of the same greatest hits album. Catastrophe losses, reinsurance, fraud, litigation, inflation, weather volatility, market instability, higher repair costs, higher labor costs, higher material costs. And again, some of that is true. But the problem is not that these pressures exist. The problem is that policyholders are usually only shown the pieces of the story that justify charging them more. They are told about claim costs. They are told about storm losses. They are told about fraud. They are told about litigation. They are told about risk. But they are rarely invited into the rest of the room. Executive compensation, lobbying, advertising, administrative overhead, shareholder expectations, claim defense expenses, vendor management systems, software platforms, layers of internal claim review, and the beautiful little industry habit of spending money to explain why they cannot pay money. That is the part consumers need to understand. An insurance company is not just a claims-paying machine. It is a financial machine. It collects premium, it invests money, it manages risk. It answers to regulators. It answers to shareholders. It builds reserves. It pays executives. It pays lawyers. It pays vendors. It pays lobbyists. And then eventually, maybe, if all the paperwork is perfect, the moon is in the correct position, and your damage is not blamed on humidity, age, wear, tear, neglect, installation, maintenance, pre existing conditions, long term seepage, or the mysterious ghost of not covered, it may pay the claim. So when consumers get a rate increase, they should not just ask why their premium went up. They should ask what system they are funding, because that is the real question. Now, here is why this matters more than a normal private business pricing issue. Insurance is not optional for most Americans. If you own a home with a mortgage, your lender requires homeowners insurance. If you finance or lease a vehicle, your lender requires auto insurance. If you drive, state law may require coverage. If you own a business, your lease, lender, contracts, or licensing requirements may require coverage. So, this is not like choosing whether to upgrade your phone or buy the fancy coffee machine. Insurance is often mandatory. And when a product is effectively mandatory, transparency should not be treated like some luxury feature. It is the bare minimum. But what are policyholders experiencing? Higher premiums, higher deductibles, reduced coverage, more exclusions, more roof limitations, more water damage restrictions, more cosmetic damage exclusions, more non-renewals, more take-it-or-leave-it policy language, more confusion, more policy language that basically says, please see paragraph 74, subsection B, exception to the exception, unless excluded by endorsement number 912, which we mailed to you in 6-point font during a thunderstorm. That is not transparency. That is paperwork warfare. And the market is getting worse for many consumers because in some areas, the choices are shrinking. Some carriers are pulling back. Some are reducing coverage. Some are raising deductibles. Some are avoiding certain zip codes. Some are non-renewing older homes. Some are forcing policyholders into more expensive or less flexible options. So when the industry says consumers can shop around, that may be technically true. But in many places, the options are expensive, more expensive, barely available, or congratulations, welcome to the state-backed market. Wonderful marketplace, very healthy, totally normal, nothing to see here. That is why executive compensation matters in this conversation. Because when consumers are forced to buy a product, and that product becomes more expensive and less protective, the public has every right to ask where the money is going. Now let's talk about the number that should make every policyholder stop and think. According to the Consumer Federation of America, top executives at the 10 largest insurance companies received more than $134 million in total compensation in 2024. That was reportedly about a 27% increase from the year before. Again, this does not mean every dollar of your premium increase went directly into an executive's pocket. That would be too simple. And frankly, if it were that obvious, they would need a better public relations department. The issue is not direct math. The issue is contradiction. Policyholders are being told their premium has to go up. Their deductible has to go up. Their coverage has to go down. Their policy may not be renewed. Their roof is too old. Their home is too risky. Their zip code is too risky. Their claim needs more review. Their contractor is too expensive. Their public adjuster is unreasonable. Their attorney is the reason premiums are high. Their estimate is inflated. Their damage is excluded. Their loss is under investigation. And their patience is appreciated. No, it is not. Let's stop pretending anyone appreciates being delayed, underpaid, or buried in claim correspondence. Meanwhile, at the top of the same industry, compensation rises. So the fair question becomes this: where is the shared sacrifice? If policyholders are expected to absorb market pain, why does the pain always seem to stop before it reaches the Executive Compensation Committee? Why does the homeowner get the rate increase, the weaker policy, the higher deductible, and the non-renewal notice, while the people running the system get rewarded. That is the part people understand immediately. You do not need a law degree. You do not need an actuarial model. You do not need a catastrophe modeling software subscription. You just need a mailbox and a renewal notice. And if you have opened one recently, you already know exactly what this feels like. Because this is where policyholders actually experience the insurance industry. Not in annual reports, not in investor calls, not in polished statements about market stability. In the claim. The moment something happens to your home, your business, or your property, you find out what your policy is really worth. And many policyholders learn a painful lesson. The company that was very friendly when collecting premiums can become remarkably suspicious when it is time to pay benefits. Suddenly, every damaged item needs more documentation. Every repair cost is questioned. Every contractor is too expensive. Every scope item is excessive. Every room needs another review. Every photo needs context. Every estimate needs explanation. Every delay is reasonable. Every denial is carefully worded. And somehow, the carrier's estimate often comes back with numbers that look like they were prepared by someone who has never hired a contractor, replaced a roof, bought drywall, dealt with code compliance, opened a wall, handled mold, or tried to rebuild anything outside of a spreadsheet. That is not an accident. That is the claim defense machine. Now, not every adjuster is bad. Not every carrier decision is wrong. Not every claim is covered. Not every estimate from a policyholder is perfect. Fair is fair. But there is a larger pattern policyholders need to recognize. The insurance company controls the first version of the claim narrative. They assign the adjuster, they select the vendor, they write the estimate, they interpret the policy, they issue the coverage letter, they decide what they believe is owed. And then the policyholder is expected to accept that, as if it came down from Mount Sinai on a tablet. No, it is an opinion. It may be right, it may be wrong, but it is still an opinion. And when premiums keep rising, while claim payments are narrowed, delayed, defended, and reduced, policyholders should ask whether they are paying for protection or paying for a system designed to avoid providing it. That is the ugly question. But ugly questions are usually where the truth is hiding. So what should homeowners, drivers, and business owners do with this information? First, stop reading your renewal like it is just a bill. It is not just a bill. It is a contract change opportunity for the insurance company. Look at the premium, yes, but also look at the deductible. Look at the exclusions. Look at the endorsements. Look at roof limitations. Look at water damage limits. Look at cosmetic damage language. Look at ordinance or law coverage. Look at matching issues. Look at actual cash value versus replacement cost. Look at what changed from last year. Because sometimes the premium goes up while the coverage goes down. That is a special kind of math. Apparently, insurance math. Second, save everything. Save the old policy, save the new policy, save renewal notices, save non-renewal letters, save claim letters, save emails, save photos, save estimates, save every document. Insurance companies document everything. Policyholders should too. Third, when you have a claim, do not assume the first estimate is correct. It may be, it may not be, but do not confuse company letterhead with truth. An estimate is only as good as the inspection, the scope, the pricing, the policy interpretation, and the person writing it. Fourth, understand the policy is the contract, not the adjuster's tone, not the claim handler's confidence, not the preferred vendor's opinion, not the software output, the policy. Coverage starts with the policy language, the facts of the loss, the damages, the exclusions, the endorsements, and the duties after loss. That is where the truth lives. Usually buried, of course, because apparently plain English was unavailable when they drafted the form. And finally, demand transparency. If the insurance industry wants consumers to accept rising premiums as unavoidable, then consumers have the right to ask about all the costs. claims, risk, reinsurance, fraud, litigation, executive compensation, lobbying, administrative overhead, claim defense, all of it, not just the parts that make the policyholder look like the problem. Here is the bottom line. The policyholder should not get the rate hike, the weaker policy, the higher deductible, the non-renewal notice, the claim delay, the underpayment, and the lecture, while the executive suite gets the raise. That is not reform. That is not stability. That is not consumer protection. That is a business model. And people are finally starting to notice. According to the Consumer Federation of America, insurance executives at the 10 largest companies received more than $134 million in total compensation in 2024, up roughly 27% from the year before. So, the next time someone tells you your premium is going up because everyone is suffering, ask a simple question. Everyone? Because from where policyholders are sitting, some people seem to be suffering through record compensation. Must be brutal. This has been the NAPAICC Insider. Read issue 57. The numbers are not subtle. If you are a homeowner, business owner, contractor, attorney, public adjuster, or anyone paying insurance premiums in America, this issue matters because insurance is not optional for most people. Your mortgage company may require it. Your auto lender may require it. State law may require it. Your business contracts may require it. And when a product is effectively mandatory, transparency is not a luxury. It is the bare minimum. If you find this content valuable, please help us get it in front of more people by liking, subscribing, and sharing. We genuinely appreciate your support. If this kind of content is useful to you, please like, subscribe, and share it so we can keep reaching people who need to understand what is really happening. Your support truly helps. I am Scott Harris with NAPAICC Inc. We represent policyholders, not insurance companies. And yes, that difference still matters.